So again, this will be a worrying trend in terms of the big differential, and a good student may link the big growth rate with the fall in gross profit margin. So perhaps they changed their sales mix to sell lower volume or lower priced or margin products but higher volumes, or perhaps there has been a difference in terms of the cost of sales over the couple of years that they need to investigate. And the final one, the net profit margin, is 194, 134, 2254, and then finally 98 over 2680. So again, we see the trend is declining from 9% down to 4%, or small if you go 8.8. But the key point is it's not as big a decline as the gross profit. So the big driver of this fall in profitability is at the gross profit line. So either you're changing your sales mix, or cost of sales has been running out of line, so it needs to be investigated further. But they are the types of comments you would make for Part A in terms of profitability. So you're asked, you would structure, and look how the examiner has structured it. For example, I look at page 39. They've given you the appendix to calcs, but they've just given a couple of lines, profitability, and a couple of bullet points. Nothing more than that, but keep it structured and try and make it as obvious as possible to the examiner that you're targeting the key sections that they have looked at. They've given you profitability ratios, they've given you working capital, they've given you gearing, so come back deliberately and answering each of those. So I typically leave those calculations in an appendix, showing your workings of where you're coming from, and then comment, have a profitability, for example, as the solution has, and make some strategic 3 or 4 bullet points and move on. Remember, it's only 8 marks. There's a lot of work involved for 8 marks. There won't be that many marks going for each part, so don't overkill the narrative part either. So that's your profitability. The next one we'll call working capital management. So we have inventory turnover, trade receivable days, trade payable days. So we have the 3 years. Just copy this down. So this is a good practice in terms of 1, your calcs, but also 2, your interpretation. So both are 30 days. So inventory turnover is cost of sales over closing inventory. So in our case, it will be 840 divided by 600. So there it is 1.4 times. So 2012 it is 924 over 655, and 2013 it is 1340 over 800. So we can see here, the higher the inventory turnover, the more efficient you are at using your inventory. So we can see here we're way out of line, or Hoskins is way out of line in terms of the industry average. They're keeping way too much stock, which again, if you read the story or read the narrative around it, this makes sense, because they said, if you link it back to the question, and the good students will do this, they've said here the entire inventory is manually recorded in the ledger, and Joe has been very concerned never to let a customer down and held much more inventory than was necessary. And they've actually filled the old premises up with inventory. So a good student will link that back to say that's the primary reason that there's such a poor inventory turnover, is we're keeping way too much inventory that is required for the business. Trade receivable days will be trade receivables, which is 1300, 2011, divided by sales times 365. So it's 214 days. Let's do them here. 214 days in 2011. 215. 2012 it is 1200 over 2254 times 365. It is 194 days, and then in 2013 it is 1125 divided by the revenue times 365. So we can see here, even although it's improving in that we're reducing the number of days, which is positive, it is still 5 times larger than the industry average. And the examiner did provide you with some narrative to link that back to, and they told you here, salesman has showed Brian the outstanding receivables ledger. Some appear to be outstanding for a long time. Although 30 days was the normal policy, many loyal customers took a lot longer. So you can see there was very much an ad hoc basis in terms of management, and that's lending to poor working capital management. So it's way out of line with the industry average, and a lot of them could be actually bad debts if they haven't paid in that while. Final one then is trade payable days. And again, remember, we actually have, our Hoskins have 0 trade payable days because they don't hold any trade payables. So you can see in the appendix, there's no current liability for trade payables, and the good student will link that back. The reason for that is Joe hated owing suppliers money, so always paid cash on delivery, even though the normal credit terms were 30 days. So again, you're not really being efficient with your working capital because you're turning down a free source of credit, which is your supplier days, but you don't seem to be getting any benefit, such as a discount for paying on cash. So again, that again suggests poor working capital management. So overall, your comments would be both inventory turnover and trade receivables are improving, but they are still way out of line with the industry averages. And again, you may link, the good student will link that back to the narrative explaining what the key drivers of that. Make sure not to double up. Don't make some recommendations in Part A. Keep that very explicit for Part B to make sure you get your marks. But once you have the ratios calculated, there's a number of key comments, short bullet points, get your marks and move on. But there may only be 2 or 3 marks going for this in total, including the calculation of the ratios. The final one then is your gearing and your interest cover. This is really looking around the debt position. The average gearing is 35% for the industry and 7.5 times interest cover. So gearing in terms of Hoskins, we know they have one long-term debt. So the gearing ratio is 2740 divided by 2740 plus your equity, which is 4823. So it's debt over debt plus equity. That's about 36%. In 2012, it's 2740, same debt over. So again, it's marginally decreased, but nothing major. And then finally in 2013, it's still 2740 divided by 2740 plus 4987. So we can see in terms of gearing, they're very much in line with the industry average, which suggests from that perspective the debt position is suitable or is sustainable. However, another one we could be looking at is the interest cover. And this really looks at how sustainable the debt is in terms of affordability on an ongoing basis. So the interest cover is your operating profit, which is 443 in 2011, divided by your interest, which is 225. So it's about 1.9 times, 1.97 times in 2011. 2012, it's 368 divided by 218. So about 1.6 times. And 2013, it's 345 over 235. So down to about 1.4 times. So again, the key comment there is it's clearly that we're a lot lower interest cover than the industry average, which again would call into question the sustainability of the interest payments on an ongoing basis. If this is the profitability level and that level of interest, it may call into question how sustainable that debt position is going forward. Because if you're only covering 1.5 times, if you have any further fall in profitability, you may not be able to pay your interest and you may actually become in default, which the bank may then take over via receivership. So that is a worrying trend. Gearing is okay, but in terms of a trend, it's disimproving, so it's getting lower, and it's way off the industry average. But that's all the comments you need to make. Save your recommendations then for Part B. Right. So if we look at that, there's a relatively straightforward Part A, but it was very broad, so the key thing was your structure, and also make sure you comment both on the trend and compare to sectoral information. So if we look at the examiner, what the examiner said, that's how the examiner laid it out. They did a heading for each to show that you're hitting each of the points. But another thing just to understand is the examiner feedback. So it was reasonably well answered, average of 5 out of 8. But again, given that this was very much Cap 1 level, students are clearly throwing away easy marks. Particularly they calculated the ratios wrong, which again was worrying because it is an open book exam. And also remember, some students didn't actually even compare. So they didn't compare performance to sectoral information, and the examiner said you're missing out on easy marks. So it's important to make sure to read the question and be deliberate. So the examiner said sometimes they started off in giving comments, but as they got to the end of the ratios, they gave no commentary. So the examiner said candidates need to work chronologically through the calculations for all 3 years and compare also. So you have to be very rigid. Don't just wean off towards the end because you're focused on the next part of the question. Make sure you hit every requirement in the question deliberately. The next part of this question is very much linked to part A. It's asking you advise Hoskins on particular actions to address any concern. So we found another issues from part A, and we know what the narrative is about. So now you just need to be very succinct. Here's my 4 or 5 key issues and explain why. So what students were doing in part B was they were making some comments that were relevant for part A. Part B only wants the actions. So for example, for the ratios, one key action is investigate gross profit margin. So why is that falling? You need to control your cost of sales better, or review your sales mix in light of the big growth. So looking at working capital management, again we could make 2 comments here. You need to drastically improve your inventory turnover. That means reduce down the level of inventory you hold. In particular, there's no need to hold that much inventory in the old premises. And review your policy in terms of how much inventory you actually need in the business. That should again improve your inventory turnover. And again, you need to also have better management of your trade receivables and trade payables. So whether you want to keep them as one general recommendation, you could at least get 2 separate ones, such as review trade payables policy. If you're still going to remain paying on cash, look for a discount because you're paying yearly. Otherwise, take the 30 days. You're also going to have to get stricter with your customers to get the payments in on time, or if not, you're going to have to charge some penalties to try and entice people to pay earlier, or perhaps offer them a discount. But there needs to be a more formal process here because it is way out of line with the industry average. The final recommendation based on this part, or the ratios we've already calculated, could be you need to re-look at your debt situation. Although the gearing level is not too high and it's in line with the industry, interest cover is not sustainable and it's a worrying low level. So you need to look at perhaps paying down your debt, and the good student will link this to the possibility that you do have 65%, so over half of this, or over 1.5 million of this is actually surplus. It's the old premises you need to sell off. So that's how you make strategic use of the narrative in the question. You know the old premises there, it's really just gradually filling with inventory. So a good student will link that and say sell down that inventory to improve this turnover, and then use the proceeds for the premises to pay down some of the debt. Or of course you could recommend use some of your cash that you have to pay down the debt to reduce your interest. But again, the key point was you need to make some recommendation around the gearing level or the interest to reduce it. So either to pay off the overdraft, which may be inexpensive in terms of interest cost, or to pay down the debt level by selling off the surplus asset, which is the old premises. Right, so that's how you use. You're very strategic, you're very deliberate, and particularly look at the examiner feedback for this section. The examiner found that much of the commentary here was given credit in part A. So they actually didn't read the question carefully. Very few candidates actually gave actions. So if you're asked for advice, you need to make sure you give actions. Majority candidates focused their answers around working capital and scored half marks. So yes, these 3 were valid comments, but there was plenty of comments around profitability, gearing, and the sale of the surplus premises as well. So candidates appeared competent identifying the areas, but less competent with recommendations. So you need to be able to recommend at CAP 2 level. So overall, that was a fairly typical question in terms of financial analysis at SFMA. Sometimes you may be asked to calculate ratios, other times they will be given to you, and it's more about interpretation. But the key thing is 2 key points to take away. You need to be able to tell the story using the narrative. There will be a lot more narrative in these questions than in CAP 1. And the second thing is you need to be able to make recommendations and specific advice of how to rectify issues. So that was Autumn 14, question 3, focused on financial analysis.